You buy a piece of land, some cows, a barn, and you're in business. That's the mental image most people carry around for dairy farming. Cows are a kind of biological machine that turns grass into money twice a day, every day, forever. Milk is one of the most bought grocery items on Earth, so the farm behind it should be one of the more dependable businesses in agriculture. It isn't. In the United States, the average dairy operation has been losing money on the actual act of producing milk for roughly the last decade. Not occasionally, but almost every single year, according to cost of production data tracked by the University of Illinois Farm Business Farm Management Association. In 2024, the average Illinois dairy farm took in $21.63 for every 100 pounds of milk it shipped. Producing that same 100 pounds cost $23.56 once every real expense was counted. That's not a rounding error. That's a business selling its core product for less than it costs to make, year after year, and somehow still being in business. Understanding how that's possible and why it keeps happening tells you almost everything about how modern dairy farming actually works. Start with the part almost nobody outside the industry knows. Dairy farmers don't set the price of their own milk. They don't negotiate it, they don't post it, and in most cases, they don't even see it coming until the check arrives. Since the 1930s, most milk in the United States has been priced through a system called Federal Milk Marketing Orders. It sounds bureaucratic, and it is, but the mechanism behind it is what actually decides whether a farm survives the year.
Here's how it works. Instead of asking what it costs a farmer to produce a gallon of milk, the government formula asks a completely different question. What did cheese, butter, and milk powder sell for on the wholesale market last week? Processors are required to pay farmers a price built backward from those product values, minus something called a make allowance, an estimate of what it costs the processor to turn raw milk into cheese or butter. In other words, the price a farmer receives is anchored to the market for finished dairy products and to processors' manufacturing costs, not to the farmer's feed bill, land payment, or labor. That single design choice explains a lot of what looks strange about this industry from the outside. A farmer's costs can rise. Corn prices spike. A drought pushes up hay. Veterinary bills climb. And the milk price doesn't have to move at all, because it isn't built from the farmer's costs in the first place. It's built from what a cheese plant 3 states away is charging a distributor. The farm and the price it receives are structurally 2 different economic universes that happen to be connected by a truck. That gap between cost and price is not new, but it has been getting worse. Feed alone, corn, protein, hay, ate up about 49% of the total cost of producing milk in 2024, averaging $11.64 per 100 pounds. Everything else, labor, equipment, land, interest, veterinary care, insurance, added another $11.92, which was the highest non-feed cost on record. Add those together and you get a break-even point that, in a lot of years, simply sits above whatever the federal pricing formula spits out. The USDA's own forecast projected the average milk price would fall another 7% in 2025. Extension economists in Wisconsin, one of the country's biggest dairy states, were telling farmers heading into 2026 to expect prices in the $18 to $19 range, and were blunt that this would not cover the break-even point for a large share of producers.
So, how does a farm survive selling its main product at a loss? This is where the popular image of the family dairy farm starts to break apart and where the real economics take over. The first answer is scale, and it is brutal in its simplicity. A farm milking 2,000 cows does not just make more milk than a farm milking 100, it makes each unit of that milk more cheaply. Fixed costs like equipment, land improvements, and management get spread across far more animals. USDA's Economic Research Service has documented this directly. Larger dairy operations have a persistent, measurable cost advantage per hundredweight of milk over small and mid-sized farms, and that advantage doesn't erode over time, it compounds. A small farm isn't just having a bad year when its costs run higher than a megadairy's. It is structurally, permanently disadvantaged against an opponent that gets cheaper the bigger it gets. That single fact, bigger is durably cheaper, has been quietly reshaping the entire industry for half a century, and the numbers are almost hard to believe. In 1970, the United States had more than 648,000 dairy farms. By 2022, that number had fallen to 24,470. By 2026, industry estimates put it closer to 23,500. That is a 95% collapse in the number of operations, not because Americans stopped drinking milk entirely, but because
because the system rewards size so heavily that anything below a certain scale becomes almost mathematically unsustainable. The average U.S. herd size has climbed accordingly, about 112 cows per farm in the year 2000, 283 by 2021, and somewhere north of 400 by 2025. Today, more than 60% of all the milk produced in America comes from farms milking over 2,500 cows. Here's the detail that makes this more than a story about farms getting bigger, though. The total number of dairy cows in the U.S. hasn't collapsed the way the number of farms has. Roughly the same amount of milk, sometimes more, is now being produced by a fraction of the operations. The industry didn't shrink, it concentrated. Every family farm that closed didn't necessarily mean less milk on shelves. It usually meant that farm's cows, land, and market share got absorbed into something much larger. That raises an obvious question. If scale is the winning strategy, why hasn't every remaining farm simply gotten big enough to be safe? The answer is the second hidden piece of dairy economics. The cost of getting bigger is enormous, and it has to be paid in cash, up front, long before the extra cows generate $1 of extra revenue. A single dairy cow, before she produces a drop of sellable milk, represents years of investment. She has to be raised or purchased, bred, and fed for roughly 2 years before her first lactation. Barns, milking armors, manure management systems, and feed storage for a modern operation run into the millions of dollars for anything approaching real scale. Robotic milking systems, increasingly common on mid-size farms trying to control labor costs, can run several $100,000 per unit. None of this debt cares whether the milk price formula happens to be favorable in a given year. The loan payment is fixed. The milk price is not. This is the trap smaller and mid-sized operations fall into. They are too big to survive on nostalgia and too small to get the cost advantages of a mega dairy, and the capital required to cross that gap is often more than the farm's remaining equity can support. So what actually happens to the farms caught in the middle? Some of them find a second source of revenue that has nothing to do with the milk at all, and it's the most counterintuitive part of this entire industry. A dairy cow that stops producing enough milk to be worth keeping doesn't retire. She's sold as beef. In 2024, the average dairy farm sold about 529 pounds of beef per cow. And thanks to a nationwide cattle shortage that pushed beef prices to historic highs, that beef sold for an average of $353 per 100 pounds, more than double the previous 5-year average of roughly $170. For a lot of dairy operations, that beef check was the difference between a bad year and a catastrophic one. The product people picture when they think dairy farm, milk, was often the part of the business losing money. The byproduct nobody thinks about was quietly propping up the balance sheet. That's worth sitting with for a second, because it inverts the whole mental model people start with. The farm looks like a milk business. The cows are milked twice a day, the trucks that come are milk trucks. The whole visual identity of the operation is built around milk. But in a year like 2024, a meaningful slice of a dairy farm's actual profitability came from an unrelated commodity market, beef, that most customers buying a gallon of milk at the store have never even connected to the farm it came from. The third thing keeping marginal farms alive is government support, layered quietly underneath the milk price. Dairy assistance and cooperative patronage payments added roughly 64 cents per hundredweight to farm returns in 2024. Not a huge number on its own, but in an industry where the gap between cost and price is often measured in single dollars per hundredweight, 64 cents is the difference between surviving the year and not. Even with beef windfalls and government patronage stacked on top of the milk price, the honest number from a decade of Illinois farm data is this: total returns from milk have not exceeded the total economic cost of producing it in any of the last 10 years, not once. Farms have consistently covered their cash costs, the bills that show up immediately, like feed and fuel, but not their full economic costs, which include a fair value for the farmer's own labor, depreciation on equipment, and a return on the capital tied up in land and cows. That gap gets paid for somehow. Usually, it's paid for out of equity, the accumulated value of land that's often been in a family for generations, slowly being spent down to subsidize a business that, on paper, isn't generating a real profit. Now bring in the piece that made this system's fragility impossible to ignore: what happens on the other side of the farm gate, where the milk actually goes. For decades, the company most Americans didn't know they depended on was Dean Foods. It was the largest fluid milk processor and distributor in the country, the company behind familiar store brands, and a huge share of the store brand milk sold at supermarkets nationwide. At its peak, Dean ran 60 processing plants, employed 16,000 people, and put roughly 8,000 refrigerated delivery trucks on American roads every single day. Fluid milk, the kind you pour on cereal, made up about 2/3 of its sales.
Then, on November 12, 2019, Dean Foods filed for Chapter 11 bankruptcy. It wasn't a sudden shock. The company had lost money in 8 of its previous 10 quarters. The reason wasn't a farm-level crisis at all. It was a consumption crisis, decades in the making. Per capita fluid milk consumption in the U.S. had fallen more than 40% since 1975 as Americans shifted towards soda, juice, and eventually oat and almond milk. Between 2012 and 2017 alone, dairy milk sales fell 15%, while non-dairy alternative sales climbed 61%. Walmart opening its own milk processing plant to supply its stores directly took away one more piece of Dean's business. A company that had spent decades buying up competitors, it acquired more than a dozen milk companies and merged with its largest rival between 1987 and 1998, suddenly looked less like a dominant giant and more like a structure that had grown too large to adapt. Here's where the chain reaction the rest of this video has been building toward finally lands on the farmers themselves. Dean wasn't just a store-brand milk company. It was the outlet, the buyer, for hundreds, if not thousands, of individual dairy farms, many of them shipping milk through the Cooperative Dairy Farmers of America. According to the credit rating agency Moody's, Dean alone represented roughly 20% of the milk volume moving through DFA, the nation's largest dairy cooperative. When Dean filed for bankruptcy, DFA didn't have the luxury of standing back and watching. If Dean's plants closed, thousands of farm families would have nowhere to physically send their milk, a product that can't be stored for long and has to move within days of leaving the cow. DFA moved to acquire a chunk of Dean's plants directly out of bankruptcy, just to keep an outlet open for its own farmer members.
And then, within months, the second largest fluid milk processor in the country, Borden Dairy, filed for bankruptcy too. 2 companies that together processed an enormous share of the milk Americans drink were both in Chapter 11 at the same time. The Department of Justice actually had to step in and force divestitures during the sale of Dean's plants, worried that letting the surviving cooperative absorb too much of that capacity would leave farmers in parts of Wisconsin, Illinois, and New England with essentially one buyer for their milk and no leverage at all. That's the real lesson buried inside the Dean Food story, and it explains something that looks contradictory on the surface. Milk consumption falling should, in theory, mean less milk gets produced and prices should rise to reflect scarcity. Instead, production kept growing through this entire period because individual farms, especially the large-scaled operations built to survive on thin margins, had every incentive to produce more, not less, to spread their fixed costs further. More milk chasing shrinking demand is a textbook recipe for weak prices, and weak prices are exactly what the Federal Milk Marketing Order formulas transmitted straight back to farmers, regardless of what it had actually cost them to produce that milk. So follow the full chain from the beginning. Consumption habits shift away from fluid milk. Processors who built their business on fluid milk lose money and consolidate or fail, concentrating buying power into fewer companies and cooperatives. Farmers, especially small and mid-sized ones, become price takers in a market with fewer buyers and a pricing formula divorced from their own costs. Feed and land costs keep climbing regardless of what the milk price does. The gap between the two gets covered by burning through farm equity or by revenue streams, beef, government patronage payments that have nothing to do with milk itself. Eventually, the equity runs out, or the next generation looks at the math and decides not to take over, and the farm sells its cows and its land. The land and the herd gets absorbed into a larger operation that can survive on the same weak price because it's spread across thousands more cows. The number of farms falls again, the average herd size climbs again, and the whole cycle resets at a slightly larger, slightly more concentrated scale than before.
None of this means every dairy farm is doomed, and it would be dishonest to end there. The optimistic outcome is real for a specific kind of operation. Very large, low-cost producers with strong genetics, tight feed efficiency, and enough scale to absorb bad years, especially those who've diversified into their own processing or captured premium markets like organic milk, which the USDA has found tends to produce both higher costs and higher net returns than conventional production. Robotic milking and better herd management software have genuinely lowered labor costs on farms that can afford the upfront investment. And commodity swings do occasionally break in farmers' favor, the way the 2024 beef market did. The realistic negative outcome is the one that's already been playing out for 50 years and shows no sign of slowing. A small or mid-sized farm run by a family with genuine expertise and a herd in good health simply cannot out-earn its own cost structure inside a pricing system built around processor economics rather than farm economics. It survives for a while on savings, on off-farm jobs, on selling cull cows into a hot beef market, and eventually it doesn't survive at all. Not because anyone farmed badly, but because the entire structure of how milk gets priced in America was never designed to guarantee that a farm's costs and a farm's revenue would ever meet.
So the assumption you probably walked in with, that a dairy farm is a cow-powered cash machine, steady and simple because people will always need milk, turns out to be almost backward. People do always need dairy products, and Americans consume plenty of cheese and butter even as fluid milk consumption falls. But the money in that system doesn't flow simply from consumer to farmer. It flows through a formula built on wholesale cheese and butter prices, through processors who consolidate or collapse based on habits that have nothing to do with any individual farm's management, and through a scale advantage that rewards getting bigger far more reliably than it rewards producing milk well. A dairy farm isn't really a business that sells milk. It's a capital-intensive manufacturing operation trapped inside a pricing system built for someone else's convenience, kept upright year to year by scale, by the beef check nobody thinks about, and by families willing to absorb the difference between what milk costs to make and what the market says it's worth.